Greetings, clients and friends of Single Point. It's Rene Harkin, CIO of Single Point. Thinking it's about time for us to reconnect. As is the tradition, I'd like to start this by relaying to you what are some of the most common things that we're hearing. And you see here the front page of the Financial Times, which is a London-based financial newspaper, basically their version of the Wall Street Journal. And it's tough to be optimistic or to feel optimistic, right? There's a lot of negative news coming out of Washington around the administration's plans to pass additional infrastructure bills, both for public infrastructure, but also human infrastructure. There's a debt ceiling fight going on. There is the reappointment of Jay Powell, who is the current chairman of the Federal Reserve, and there's a fight about who should succeed him or if he should be renominated, and that's obviously creating some uncertainty. In China, of course, we have the situation with a sharp slowdown in the real estate sector. A very large home builder, a company called Evergrande, is basically at this point insolvent and in the process of being put through a restructuring process. That's not good news. Of course, we also hear news about labor shortages, about shortages of semiconductor chips that go into everything, but especially autos. That's leading to shortages of cars. We hear about inflation. So in general, the headlines are all pretty negative. And so with that being said, how do we explain or rationalize the fact that the S&P 500 is up 15% this year? And I've now just switched the view to a graph of the last 20 years of the S&P 500 in purple and the level of the S&P 500. We're at about 4,300. We've had a very strong 2021 despite the pullback of about 3 or 4% in the last couple of weeks. And a lot of folks, quite honestly, are perplexed and confused by how the market could be at such levels. The short answer, and what I'm going to try to do today, hopefully in 3 or 4 minutes, is just kind of focus you on what the market focuses on and what the market believes is the determining factor for the level of the S&P 500, and that is the profit generating capacity of those 500 companies. And the orange line that you see here, again, for the last 20 years, tracks the sum or the aggregate of all of the profits of these 500 entities and treats them as if it was one single profit stream. And if you look at the behavior of the orange line and the purple line, you'll see that they're highly correlated, right? You'll see that 20 years ago, the S&P 500 was generating about $27 over here. If you look at here, about $27, $27. Fast forward 20 years later, and you're at $158 is the most recent number. In the meantime, through the Great Recession, coming out of the Lehman bankruptcy and the collapse of a lot of the big banks on Wall Street, we saw earnings take a big hit down, and we saw the S&P 500 follow that same pattern. And then we see the recovery in profits, right, in the years after 2010, and then we see the recovery in the S&P 500. Okay? Fast forward to the Great Pandemic and the lockdowns. This little gray area signifies recession. And again, we saw a big collapse in corporate profits. There's the orange line. And in particular, 2020 was a brutal year for profits. Interestingly, the S&P 500, except for this initial correction, really has rebounded much faster than the rebound in corporate profits. And that's a reflection of the fact that the market, because of the emergence of the vaccines, effectively assumed that once we get back to normal, we would get back to a more normal profit generating capacity for the U.S. corporate sector. And in fact, that's what's happened. So you see the big rebound here. In about 2 weeks, companies will start reporting their Q3 profit status. And the earnings expectations for that is that this is going to go even higher. So let me show you a different view. And again, this is the profits per share of the S&P 500 in the aggregate. Again, 10 years ago in 2011, it was at 100. It peaked at 163 the year before the pandemic. During the pandemic, it drops dramatically to 140. And this year, calendar year 2021, we're on track to surpass 200, right? So profits are absolutely growing as fast as the S&P 500. And today the consensus, and this obviously can be adjusted and will be adjusted, but the consensus is that next year, next calendar year, we'll see a 10% increase in profits. More consistent with kind of the norm, the historical norm. But coming out of the pandemic and through the embrace of a lot of these technologies and companies moving to digital only, they've been able to wring a lot of cost out of the system and actually expand their profit margins. And that's what you're picking up here, right? I think another interesting view, again, this is the PE multiple of the S&P 500. This basically says, how much do I pay for every dollar of profits, right? So in the recent history, you typically pay somewhere between $20 and $23 for a dollar of profits, right? And before the recovery in profits, this ratio was really out of whack. It was over 30 times a dollar of profits. But as companies reported Q1 profits and then Q2 profits, right, we saw the PE multiple decline. Okay? And this is exactly what we would expect, right? As the market is a forward-looking discounting mechanism, and it was anticipating a massive jump in profits, which is exactly what's happened in 2021. Hopefully this is useful. I'm happy to entertain any questions you may have after hearing this. Thank you. Have a nice weekend.